Hi there. Welcome to the final review on reading 25 of the CFA curriculum that deals with understanding the income statements. So we'll understand what we mean by the capital structure of a company and then go on to study the very important concepts of basic and diluted EPS. The capital structure of a business defines how the business has been funded. That is, how much debt, broadly speaking, and how much equity has the company used to fund its business. In a simple capital structure, there are no potentially dilutive securities. That is, it contains of common stock that we've already studied, non-convertible debt or regular debt that we've been talking about, and non-convertible preferred shares or preferred stock that also we have studied in the previous reviews. In a complex capital structure, over and above these securities, there are some potentially dilutive securities. We call them potentially dilutive as they can potentially reduce the EPS of the company. Some examples of these securities include options, warrants, convertible debt, convertible preferred shares, as we will study in the coming slides. Companies with complex capital structures must report both basic and diluted EPS, whereas firms with a simple capital structure that has no potentially dilutive securities must report only the basic EPS. What the basic and the diluted EPS, or what the EPS essentially is, we will study very soon. So EPS stands for earnings per share. That is the net income available for each stock. Or the earnings available per stock. The basic EPS is calculated as the net income minus the preferred dividends. Please note that these are given to the preferred shareholders, not the common shareholders of the company. So what the common shareholders will get is the net income after the preferred dividends have been paid. So net income minus the preferred dividends upon the weighted average number of shares outstanding. So we'll understand this concept with an example and in the coming slides. Samsung Incorporated has a net income of $25,000 and paid $5,000 cash dividends to its preferred shareholders and $3,000 cash dividends to its common shareholders. At the beginning of the year, there were 2,500 shares of common stock outstanding. 500 new shares were issued on April 1. Assuming a simple capital structure, what is Samsung Incorporated's basic EPS? So the basic earnings available to each shareholder is nothing but the net income. Net income in this case is $25,000 minus the preferred dividend, that is $5,000, upon the weighted average number of shares. Now, the number of shares outstanding are weighted for the amount of time that they were outstanding for. So at the beginning of the year, there were 2,500 shares of common stock. That is, 2,500 shares were available for the entire 12 months, or 12 by 12. 500 shares more were issued. So at the moment there are 3,000 shares outstanding, but for this year's EPS, or for the last year, these 500 shares were not outstanding for the entire 12 months. They were issued on April 1. So they were outstanding for April, May, June, July, August, September, October, November, December. So the year begins and ends on December 31st. So they were outstanding for 9 out of the 12 months. So the weight applied to these 500 shares would be 9 by 12. This can be calculated as 2,500 stored in the memory register 1 plus 500 into 9 divided by 12. That is 2 plus 1. So the value will be stored in memory register 1, and I can recall from the memory register 1, it comes out to be 2875. So The basic EPS can be calculated as 25,000 minus 5,000 upon 2875. That is 20,000 upon 2875, or $6.96. Now let's try to understand what happens when the company announces a stock dividend or a stock split. Stock dividend is sometimes also called a bonus issue. So a stock dividend is the distribution of additional shares to each shareholder in an amount proportional to their current shareholding or the number of shares. So if a company announces a 10% stock dividend, then somebody who owns 1,000 shares would additionally receive another 100 shares. If for the same company I own 100 shares, I would receive an additional 10 shares. So corresponding to each shareholder's ownership, they will all receive 10% additional shares. Similarly, a stock split refers to the division of each old share into a specific number of new, also called as post-split shares. So if a company announces a 3-for-2 split, that is, for every 2 shares, you now get 3 shares. Or if it announces a 2-for-1 split, then for every 1 share, you would get 2 shares. So if I own 1,000 shares and there was a 2-for-1 split, then I would now have 2,000 shares, because each of my 1 share is now equivalent to 2 shares. If there was a 3-for-2 split, then for every 2 shares I would get 1 additional shares, or I would have a total of 1,500 shares. That is, I would get 500 additional shares for the holding of these 1,000 shares in a 3-for-2 split. First, understand, guys, that a 3-for-2 split is the same as a 50% stock dividend. So even though the semantics may differ, first of all, let's understand that technically we're doing the same thing. So I had 1,000 shares. If I get a 50% stock dividend, even in that case, I would have 1,500 shares now, because I get 50% more shares. Similarly, a 2-for-1 split can simply be thought of as a 100% stock dividend or 100% bonus. Because in a 100% bonus also, I will have 2,000 shares for every 1,000 shares. Now, stock splits and stock dividends have no economic significance. Companies cannot create or destroy value by doing these activities. If they could, they would stop doing business and only do these things to enhance the value. So let's understand. Let's say my stock price before a split was $30 a share, and I had 100 shares outstanding. So what would be the value of my company at the moment? It would be the stock price per share multiplied by the number of shares. That is how much I have to pay to buy out the company. It is also called as market cap, as we will study. So the total value of my, or the total worth of my shares at the moment is $3,000. If the company does a 2-for-1 split, let's assume, so these 100 shares would become how many shares now? A 2-for-1 split or a 100% stock dividend would make these 100 shares into 200 shares that I own now. Now, a 2-for-1 split may double the number of shares, but will it double the company's customers? Or will it double the sales? Or will it double the company's income? Obviously not. The business will be as usual. So on doing the stock split, the number of shares double, but income remains the same, as we just understood. So what will this do to the earnings per share or the EPS that we just calculated? So if the net income remains the same and the number of shares now become twice the number that we had originally, the EPS would halve. Similarly, shouldn't the stock price halve? We can also think of it as the total value of the company was earlier $3,000. This activity cannot create or destroy value because I've just increased the number of shares. I haven't increased my customer base or my revenues or my net income. So let's assume X was the new stock price. X into 200 should also be the same value. Or if the earlier stock price was $30 per share, the new stock price will be $15. So please understand that doing a stock dividend or a stock split does not change the income or the earnings on an absolute basis. However, it will instantly impact the EPS. Now, the moment I announce a dividend or a split, my EPS will adjust downwards, and correspondingly the stock price will adjust downwards to incorporate the impact of the stock split or the stock dividend. Each shareholder's proportional ownership in the company is unchanged by either a stock dividend or a stock split, because I may get 10 more shares, but so does everybody else. Or I may get 10% more share or 2 shares for every 3 shares, but so will happen to every other shareholder. Hence, my proportional ownership doesn't change. My economic worth does not change. If I was earlier owning 10 shares worth 30, I may now own 20 shares, but they'll be worth only 15. So my total value will remain the same. So let's understand the weighting system for the calculation of the number of shares a little better. As we studied in the previous example, it is essentially the number of days that the shares have been outstanding divided by the total number of days in the year. That is the weight that will be applicable to each share. So if 500 shares are outstanding for the whole year, then it will essentially be 365 divided by 365. If they were outstanding for 50 days, then the weight applied to those shares would be the number of days they were outstanding upon the total number of days in the year. Sometimes the monthly approximation can also be used for the CFA exam, as we studied in the previous example. New shares issued would enter into the computation from the date of issuance. Any shares that were reacquired will go out of the computation or will be excluded from the calculation from the date that they were reacquired. Please note, these are not stock splits or stock mergers or stock dividends. Any stock split or a stock dividend will be applied immediately to all shares outstanding prior to the split or the dividend, including the beginning of period weighted average shares. So let's assume that the company had 100 shares outstanding on 1st of January, that is at the beginning of the year, and on 31st December, the company announces a 2-for-1 split. That is just one day before the accounts were being closed, or on the day rather of the accounts being closed, the company announces a 2-for-1 split. And let's assume we had 100 shares outstanding. So at the end of the year, we would have 200 shares outstanding. Now please tell me that would the EPS instantly halve and would the share price instantly halve on this announcement? Because there is no additional cash that has come into the company as would have happened when the shares were issued, or there is no cash that has gone out as in a reacquisition. So the number of shares doubled from 100 to 200, the stock price halved, and the EPS also halved, as we studied in the previous example. Now, if we continue to use our traditional methodology of weighting the shares, then these additional 100 shares won't figure in the calculation because they were outstanding for just one day. Whereas the EPS would have halved, the stock price would have halved. Hence, guidelines mandate that if there is a stock split or a stock dividend, which we've understood has no economic meaning and instantly impacts the EPS and the stock price, then all outstanding shares will proportionately be adjusted for the stock split or the stock dividend. So in this case, all outstanding shares prior to the split, which were 100 shares on 1 Jan, would be adjusted to the extent of the split, that is a 2-for-1 split. So for our EPS calculation, we would never use the number 100. To begin with, we would use a number of 200, that is the split adjusted number. We'll understand this better with an example. The reason why this is done is because the impact is instant, there is no cash receipt, and the stock price and the EPS will always correspondingly react to a stock split or stock dividend. Stock split or stock dividend adjustment is not applied to any shares issued or repurchased after the split or the dividend date, because now these are the new shares. So incremental issuance or repurchase will happen on the new price, and the split or dividend doesn't really affect the incremental transactions. However, all prior outstanding shares have to be adjusted to that extent. So let's understand with the help of an example. During the past year, Samsung Incorporated had a net income of $25,000 and paid dividends of $5,000 to its preferred shareholders. $3,000 cash dividends were paid to the common shareholders. And the account showed the following, that on January 1, the company had 2,500 shares outstanding, issued another 500 shares on June 1. On July 1st, it declared a 10% stock dividend. Please note that whenever we hear an announcement like this, that is of a stock split or a stock dividend, we would immediately revise or adjust all shares prior to the announcement date to the extent of the stock split or the stock dividend. So it's a 10% stock dividend. Hence, for all EPS calculations, we would never use 2,500 as the number of shares outstanding. We would use 2,500 plus 10%, that is 2,750 shares, or 500 plus 10%, that is 550 shares, for the same reason explained in the previous slide, that instantly the stock price, EPS, and all similar parameters would adjust to the extent of 10%. On October 1st, what was repurchased now were the new shares. So 400 shares were extinguished, that is repurchased by the treasury. Question asks us to calculate first the weighted average number of common shares and compute the EPS. So first let's do the weighted average share calculation. 2,750 shares were outstanding for the whole year right from the beginning, plus another 550 shares that were outstanding since June 1. So June, July, August, September, October, November, December, they were outstanding for 7 months. So it'll be weighted by 7 by 12. And 400 shares were repurchased on October 1. So they were extinguished on October 1. These 400 shares are not comparable to the 500. They're comparable to the 550, and hence we need to make this adjustment. So these 400 shares have not been outstanding for 3 months starting October and throughout November and December. So minus 400 into 3 by 12 will give us the weighted average shares outstanding. I will start by saving 2,750 that have been outstanding for the entire year in the memory register 1, and then calculating 550 into 7 by 12. We'll add it to 1 and store it in 1. So store plus 1 minus 400 into 3 by 12. So let's do 400 into 3 divided by 12, and we'll press store minus 1. That is, it'll be subtracted from 1 and stored in the memory register 1. Recalling 1 will give us the answer. So it's approximately 2971 shares that are outstanding on a weighted average basis throughout the year. Now the EPS, as we studied, can be calculated as the net income, which is $25,000 in this case, minus the preferred dividend, which is $5,000. Please note that all income after paying the preferred shareholders' dues belongs to the common shareholders. So do not subtract the cash dividends. Whether you choose to pay this money out as dividends or you don't choose to pay the money out, it will still belong to the common shareholders. So this is the net income remaining with the shareholders upon the weighted average shares outstanding, that is 2971. 20,000 divided by 2971 will give us 6.73 as the EPS. So we studied the concept of basic EPS. We now move on to studying the diluted earnings per share, which comes if there are dilutive securities like options, warrants, convertible debt, convertible preferred stock that could potentially decrease the EPS if exercised or converted into common stock. So we'll take each one at a time in the coming slides. Understand, the opposite of dilutive would be anti-dilutive securities, which are similar in nature, but these securities, if exercised, would increase our earnings per share. Please note that in the computation of accounts and in the calculation of the diluted EPS, we assume that anti-dilutive securities will not be exercised, which implies that the diluted EPS must always be lesser than or equal to the basic EPS. Anti-dilutive securities will not be exercised is the assumption that we'll be working with going ahead. The first potentially dilutive security that we'll study is called a warrant. So warrants are call options issued by a firm on itself. And what is a call option? You'll study in more detail in the review on derivatives, but just to introduce, if I have 100 warrants outstanding at a price of $100, then what that essentially means is that I have the right to buy 100 shares of the company from the company itself at a price of $100. When will I exercise my right? If the actual share price is greater than 100. If the share price is less than 100, I will not exercise the right. That's what a warrant is. So a warrant has been issued by the company, which gives the holder of the warrant the right to buy a pre-decided number of shares of the company at a pre-decided price. Now, why would a company issue a warrant? Let's say that the company is going through some trouble and the debt holders or incremental lenders are asking for a 20% coupon to give them $100 or to lend any money to the company. So the company says to the lenders that I cannot afford such a high interest rate at the moment. What I can do is that I'll give you a 7% coupon and I will give you 100 warrants of my company at a price of $100. That is, you get a fixed return of 7%, and as and when my equity share sees upside, you will participate in the upside with me, or you will get these warrants. So these warrants may be used as a tool to reduce the cost of debt. Just one example of why firms may issue warrants. Sometimes they may issue warrants to employees or to other related parties who they need some economic benefit from, etc. Now the question in this review is, how should warrants be analyzed, and what is the dilution caused by the exercise of warrants? Please note that if the warrants have already been exercised, let's say the holder exercises these warrants, then 100 new shares would be added to the capital structure or would have to be issued by the company. The number of shares would go up and the company would receive the corresponding amount of 100 into $100 as 100 warrants at a price of $100 each for its use. But even if the warrants were not exercised, that is, the 100 new shares were not issued, the concept of basic and diluted EPS says that we will have to report a diluted EPS, which would hypothetically assume that these warrants were converted and what was their impact. So the analysis of warrants is done by a method called the treasury stock method. In the treasury stock method, we assume that the hypothetical funds received by the company from the exercise of the options. That is, if the holder exercises these 100 options at a price of $100, then he would have to first pay 100 into 100, and thereby he can sell the 100 shares at whatever is the market price, that is going to be higher than $100 if he has chosen to exercise. So these funds that the company is receiving from the exercise of the options are being used to offset the dilutive impact of the warrants. So please note that issuing of these warrants increases the number of shares. If the number of shares increases, it is possible that the EPS can get diluted. EPS is the net income minus the preferred dividend upon the number of shares. So if I need to offset the impact of this increase in number of shares, I will have to buy back the shares so as to reduce the number of shares and increase the EPS. So the funds would be used to purchase back the shares of the company's common stock in the market at the average market price throughout the year. However, if the market price is higher than the exercise price, then there would still be a resultant increase in the number of shares outstanding, as we will not be able to buy back as many as we have issued because we've issued at a lower price and we'll be buying it back at a higher price. So this net increase is the number of shares created by exercising the options minus the number of shares hypothetically repurchased with the proceeds of the exercise. We'll understand it better with an example in the next slide. Mobility Incorporated has 10,000 shares outstanding all year. It had 3,000 outstanding warrants all year, convertible into 1 share each at $100 per share. The year-end price of the stock was $150 and the average stock price was $125. What effect will these warrants have on the weighted average number of shares? So please note that for the analysis in the treasury stock method, the year-end price does not matter. So this is redundant information if it's given. You need only look at the average stock price to decide whether the warrant would have been exercised or not. So he has the right to buy at $100 and the average stock price was $125. So it is a fair assumption that there could have been a dilution or the options could have been exercised because you could buy at 100 and sell it for 125 in the market. So if the warrants were exercised, how much money would the company have received? There are 3,000 warrants outstanding. That is, 3,000 new shares would have to be issued by the company for receiving a price of $100. The company would have created 3,000 new shares, but would have also received 300,000 additional dollars. Now, these new shares can potentially reduce the EPS. So the assumption is that the firm will use these $300,000 to buy back the shares to offset the impact of this dilution. So at an average price of $125, how many shares could be bought back? So $125 for one share. So for $300,000, the company would be able to buy 300,000 upon 125 number of shares. That is approximately 2,400 shares. So we issued 3,000 shares and we bought back only 2,400 shares, resulting in a net increase of 600 shares. So the weighted average number of shares for the diluted EPS calculation would be 10,000 plus 600. Please note that if the average stock price was lesser than 100, if this was not 125 but let's say $90, then do not reduce the number of shares or do not demonstrate that you will issue less and buy back more shares. You will just say that the warrant will not be exercised and the diluted EPS will be the same as the basic EPS. Let's do one more example. During 2012, Brook Incorporated reported net income of $250,000 and had 10,000 shares of common stock outstanding for the entire year. Brook Incorporated also had 1,500 shares of 15% $100 par preferred stock outstanding during 2012. Brook Incorporated has 5,000 stock options or warrants outstanding during the entire year. Each option allows the holder to purchase one share of common stock at $20 per share. The average market price of Brook Incorporated's common stock is $50 per share, so exercise is quite likely. Compute the diluted EPS. So let's follow the treasury stock method again. The money received by the company from the exercise of the options would be $20 into the number of options, that is 5,000. So the company will receive an additional $100,000 that it can use to buy back shares. Shares bought back, however, will be lesser because now the shares are being bought at a price of $50. So we will be able to buy back only 2,000 shares. Or there will be a net increase in the weighted average number of shares of 5,000 minus 2,000. That is $3,000 in the diluted EPS calculation. Now let's first compute the basic EPS. That is simply the net income of $250,000 minus the preferred dividend. So he has 1,500 shares of 15% $100 par. Please note that coupon is paid as a percentage of the par. So $15, that is 15% into 100, would be paid for every share, or a total preferred dividend of 1,500 into $15 per share needs to be subtracted, divided by the number of shares outstanding, that is 10,000 in the basic EPS calculation. So we'll store 250,000 in memory register 1. We'll calculate 1500 into 15. Subtract that and store that in the memory register 1 again. So store -1. Recall 1 and divide it by 10,000. So the basic EPS, we'll just store it for future use, comes out to be 22.75. Let's now calculate the diluted EPS. So the numerator remains the same, that is the net income minus the preferred dividend upon the number of shares. Now, however, will be 10,000 plus the net increase of 3,000. That will be 250,000 minus 22,500 divided by 13,000, or $17.5. Please note the diluted EPS must always be less than the basic EPS, actually less than equal to the basic EPS. The next potentially dilutive security that we'll study is called convertible debt. So we'll understand convertible debt directly with an example. During 2012, Brook Incorporated reported a net income of $250,000 and had 10,000 shares outstanding. It also had 1,500 shares of 15% $100 par preferred stock outstanding during 2012, as we saw in the previous example. During 2011, Brook Incorporated had issued 1,000 $1,000 par 5% bonds for $1 million. Issued at par. Issued at par just means that the price of the bond, the price of each bond, was the same as its par value of $1,000. Hence, you had to pay 1,000 into 1,000, $1 million for purchasing the bonds. Each of these bonds is convertible to 5 shares of common stock. The tax rate is 30%. Compute the basic and diluted EPS. Now please note, the new information is that the bonds are convertible to common stock. So at the moment in my capital structure, there would be debt of $1 million on which I'm paying a 5% coupon. The holder of this debt, if so desires, can convert this debt into equity. So whatever my equity is will go up by $1 million if the holder of the debt chooses to exercise his option. I will have to issue him 5 shares of common stock, implying that by paying $1,000, he can convert each of these bonds into 5 shares of common stock, or an approximate value per share of $200 is what he's paying. So when will he exercise his option again, or when will he convert from debt to equity? When the market price of the stock is definitely greater than $200, or if he feels that redeeming the equity gives him more value than just keeping a $1,000 par 5% coupon bond. So let's see how this conversion will impact the EPS. Please note that the basic EPS in this question will remain the same as 22.5, since the data is exactly the same as the previous question. You can verify the calculation. Let's try to calculate the diluted EPS. So if the bonds are converted, how many new shares will have to be issued? There were 1,000 bonds, and for each bond, I have to create 5 new shares, or a total of 5,000 additional shares will get created if the bonds are converted. So the numerator in the calculation will go up from 10,000 to 15,000. That is the addition of these 5,000 shares. However, what will happen to the numerator? The net income is given to be $250,000 and a preferred dividend of $22,500. Anything else that needs to be added or subtracted? Please note that if the debt has been converted into equity, then I will not need to pay this 5% coupon anymore, because on equity there is no such obligation to pay the coupon as is required for the debt. So in this net income calculation, I would have been subtracting at the moment a coupon amount or an interest amount of 5% into the par value into the number of bonds. So $50 per bond, or a total of $50,000 of interest, is what is being paid to these bondholders. If they convert their bonds into equity, then no more interest, or to my net income I'll have to add back this interest expense. But please note that interest is a tax deductible expense. So if I'm not paying any interest, then I will not get that additional tax benefit from the tax deductible nature of interest. Let's understand what we're trying to say. So let's assume that there's a company A that had sales of $100, expenses of $50, and interest expense additionally of $30, which gave a PBT, or profit before tax, of $20, and the tax rate, let's assume, was 30%. So at 30%, $6 was given in taxes, giving us a PAT of $14. Now let's assume that this company is now exempt from paying the interest, or there is no interest expense. So we would assume that the earnings should go up by $30. But let's see what exactly happens. So sales still remain at $100, expenses at $50, no interest now, so PBT will also go up. PBT will become $50, or what happens is that my tax expense, which was earlier only $6, since this interest was reducing my taxable income, will now become 30% of 50, that is $15. So the PAT actually becomes only 35. So even without the interest expense, the PAT doesn't go up by $30. It goes up by the interest expense adjusted for the loss in tax, or adjusted for the additional tax. That is, I'll have to pay 30% of this $30 additionally in tax. So this $30 I will get because of my interest benefit, but I'll have to pay additional tax to the tune of 30%. So $9 will be taken away in this additional tax payment. So remember, if there is no interest expense, then the benefit enjoyed will only be to the extent of interest into 1 minus the tax rate, since no interest means no tax benefit also. So earnings go up by only about $21, not $30, to $35. So the $30 reduction in interest causes net income to go up by only $21. Similar increase is going to happen in our question. So there will be no interest expense anymore to the tune of $50,000, but I will also give up on the tax benefit because of this interest payment. Hence, the net increase will only be to the tune of $35,000. So we can now compute the diluted EPS. $250,000 minus $22,500. We'll store it in the memory register 1. 50,000 into 0.7, that is 35,000. We'll add this to our previous calculation and we'll store it in 1. So we get 262,500 divided by 15,000 will give us our diluted EPS. That comes out to be 17.5. Please note this is lesser than 22.5 that was our basic EPS. If this calculation was greater than 22.5, then we would just say that the diluted is the same as the basic. However, in this case, the diluted EPS is 70.5. Now, instead of doing the entire calculation only to find out that the convertible debt is anti-dilutive, here's a quick way that you can use to check whether the convertible debt is dilutive or not. So if you recall from the calculation, what exactly are we adding to the numerator? We are adding the interest that no longer needs to be paid adjusted for the tax. And to the denominator, we are adding the incremental shares that will be issued after the conversion of the debt. So if my original EPS was $22.5, then the interest gets added to the numerator and the number of shares get added to the denominator. So to the existing EPS or to the basic EPS, I'm essentially adding this ratio. Please note that to an existing ratio, if I add a ratio that is lesser than the existing ratio, then the existing ratio will come down. So if my existing ratio is, let's say, 2/3, to this ratio, if I add 1/2, then the ratio will come down. It will become 3/5, that is 0.6, whereas the earlier ratio was 0.66. We can also verify from our calculation, our earlier EPS was 22.5. To this, we are adding a ratio of 35,000, that is 50,000 into 0.7 upon 5,000. You see this ratio is 7. So a ratio of 22.5, I'm adding a ratio of 7. Hence this ratio comes down to 17.5. So you can just see the incremental change that you're making. That is the convertible debt interest into 1 minus the tax rate upon the shares issued from the conversion of the debt. If this ratio is less than the basic EPS, then the conversion should happen or the debt is dilutive. If this is greater than the basic EPS, then the conversion will not happen. You can stop solving the question and just conclude that the convertible debt is anti-dilutive and the basic EPS will be the same as the dilutive EPS. The last potentially dilutive security that we'll study is called convertible preferred stock. So during 2012, Brook Incorporated reported a net income of $250,000 and had 10,000 shares of common stock and 500 shares of preferred stock outstanding for the entire year. Brook Incorporated's 15% $100 par preferred shares, that is this preferred stock, are each convertible into 5 shares of common stock. So just like we had debt that was convertible earlier, now there is preferred stock worth $50,000. I'm assuming it is issued at par, that is 500 into 100. That will get converted into common equity if the holder so desires to exercise his option of conversion. Each share is convertible into 5 shares of common stock, or about $20 per share is the effective price that you are receiving to acquire the shares. Compute the basic and the diluted EPS. So let's first do the basic calculation. It will be 250,000 minus the preferred dividend, that is 500 shares into $15 per share, 100 into 15%, divided by the number of shares, that is 10,000. So it will be 250,000 minus 7,500 upon 10,000, that is equal to 24.25. So this is the same straightforward calculation. Let's now try to compute the diluted EPS in a similar manner. So the net income was $250,000, from which we were subtracting $7,500 worth of preferred dividend. Now, if the preferred stock gets converted into common equity, would I still need to pay this 15% dividend, or would I still need to pay this $7,500 dividend? No, I won't. So I will add back the $7,500 that I had subtracted from my net income, because this outgo now no longer needs to happen. Please note that preferred dividend was never tax deductible. So there was no associated tax benefit that we were ever getting. Hence, when the preferred stock gets extinguished, I will simply receive an extra benefit to the tune of $7,500 worth of dividend that I needn't pay any more. No tax benefit will have to be taken away, because no tax benefit was ever received. However, the number of shares will go up because of the conversion of the preferred equity into common equity. So 10,000 was the original number of shares, plus 5 shares for each of the 500 shares of preferred stock. The diluted EPS can be calculated as $250,000 upon $12,500, that is equal to $20 per share. We again see that this is lesser than the basic EPS of 24.25. The diluted EPS would be $20 per share. And just like we had a shortcut calculation to check for debt, we can similarly check that in the convertible preferred stock, what gets added to the numerator is simply the preferred dividend, because we don't have to pay that dividend anymore. And what gets added to the denominator is the new shares because of the conversion. So if this ratio is less than the basic EPS, then the convertible preferred stock is dilutive, and the diluted EPS will be lesser than the basic EPS. Else, the convertible preferred stock is anti-dilutive. So we can summarize the chapter by saying that the diluted EPS is equal to the adjusted income available for common shareholders upon the weighted average common and potential common shares outstanding. So what is the adjusted income? It is the net income minus the preferred dividends, same as our basic calculation, plus any dividends on convertible preferred stock if the conversion happens, plus the after-tax interest on convertible debt, which will not have to be paid if the debt is converted. So this is the numerator, or the adjusted income, divided by the common and potential shares outstanding. So these were the common shares, weighted average, plus the shares from the conversion of preferred stock, plus the shares from the conversion of convertible debt, plus any increase in the number of shares from the treasury stock method from the exercise of warrants or stock options, as we first studied. But before you do this calculation, please ensure that the securities are actually dilutive and not anti-dilutive. Diluted EPS must always be lower than the basic EPS. So only dilutive securities will come in the calculation. If any of these securities is anti-dilutive, then that security will have to be knocked off. So we've covered a very important and testable topic for the level 1 exam. Please make sure you practice a lot of questions on the topics covered today so that you are thorough and quick with the calculations. Use your question bank and all other sources as much as possible. Thank you so much and see you next time.